Good afternoon, everybody. Welcome to today's live event. This is Andrew Wilkinson at Interactive Brokers, and I'm joined today by Dan Sheridan with Sheridan Options Mentoring. How are you, Dan?
I'm doing good, Andrew. Good to be here today. Welcome, everybody. Glad you can make it.
Thanks for joining me again, Dan. Last time you talked about double calendars, and now we're going to talk about double diagonal option strategies. Tell us a little bit about that.
Yeah, this is, again, the second strategy that I'm talking about in the double series, and this is the double diagonal. And both strategies, double diagonal, double calendar, have the same foundation as an iron condor. And you might say, well, what is that? It's the selling an out of the money call and an out of the money put is the whole foundation of the trade. And an option parlance, that's called a short strangle. So we're going to focus on this strategy today. This is probably one of the more popular ones that I do and we do in the community. And then when we're done going through the slides, we'll leave a little bit of time at the end. And I'm going to go with Andrew on the Interactive Broker platform. And I'm going to put one on that I might be putting on today live, but it lets you see kind of the mechanics of how to do it, because I know anytime with a new trade, you get a little bit, a little bit of trepidation, but it's, you just got to get used to it a little bit. So looking forward to that today and go from there.
Okay, that's great. That's we'll dig into that at the end of the session. I'll put the disclosures up for the audience. We're talking options, and these are potentially risky. It's a risky asset class, so that's why we always put this disclosure up for you. Please ask any questions. I'm going to make Dan an organizer so that he can look at any questions coming in, and he does like to make this as interactive as possible, so he's going to be asking questions. Use the chat panel to communicate with Dan throughout the session. They'll be asking you for yes and no answers, and has anybody done this and so on. Please do interact and ask any questions. We'll do a Q&A towards the end. You'll also receive a recording link to the presentation, to the recording about 2 hours after we've wrapped up today. And there's a handouts panel where the PDF is uploaded. So Dan, you might lose audio for 1 second, just bear with me.
Sure.
As I make you an organizer. As I say, if you expand the handout section, you click on the PDF, and you can always pick that off the Interactive Brokers web page later on. So Dan, I'm going to go to your opening slide. Double strategies, double strategies, diagonal strategy. And I'll
try to say that 4 times in a row.
Excellent.
Yeah.
You, Dan.
All right. Well, folks, looking forward to this. Thank you, Andrew. And as I said again at the end, we'll take a little bit of time, and Andrew and I will concoct one on the Interactive Broker platform and just give you a little more used to the strategy. Now, let me ask you a different question. How many people here would say yes or no, Dan, I've done an iron condor in my lifetime? Yes or no, I've done something called an iron condor in my lifetime, which is selling an out of the money call and an out of the money put. And then you're buying some protection a little bit further out of the money. Now, if you said, where does the double diagonal fit in? The double diagonal would be a first cousin of the iron condor. First cousin. So to put it in as plain English as I can think of, a double diagonal is the same foundation of an iron condor, selling an out of the money call and put. The only difference is when the VIX, when the volatilities are a little bit in the lower end of the range, I would do a double diagonal. When the option volatilities are a little bit higher, I would do the iron condor. So it's really about, if this were like a dance like the tango, it's where you put your feet or where you put your longs. If we're using these same shorts basically for an iron condor, all we're saying is your longs in a double diagonal will be in a little bit further out expiration. Your longs in an iron condor are in the same expiration. So I would do a double diagonal versus an iron condor when the vols are lower, it's just basically I'm placing my longs instead of in the same expiration as an iron condor, a little bit further out. Now, Nick made an interesting comment on an iron condor. He said he lost money. The way that I would like you to look at any strategy, it's a craft, isn't it? You think about it, and Nick doesn't mean this, but do you think in life as an options, if we stopped every time, do you think people who are very good iron condor traders, do you think they ever lost? Let me ask you that. Do you think the best iron condor traders the world's ever seen, do you think they've ever lost? What do you think? Yeah. If you approach this as a craft, right? Like a double diagonal. When you hear of double diagonal for the first time, will you understand it? No. If you practice on paper doing one or two, will you get it? No, but you'll get better. But it's just a matter of doing these things. That's how I learned it. I was at the Chicago Board Options Exchange trading for over 20 years. And crazy enough, that's how I learned it. It's amazing, isn't it? This is what I'm going over is just mind-boggling philosophy, isn't it? How do you learn to get really good at cooking fettuccine Alfredo? It's an amazing thing, folks. Write this down. Get in the kitchen, get some good instruction or get some guidance and make fettuccine every day for 40 days. You'll get better at it. It's shocking, folks. I know this is crazy what you're hearing, but it's shocking, isn't it? Now, has anybody done a double diagonal? It's a little different strategy. Has anybody done a double diagonal and would like to admit in public that they've done a double diagonal? All right. Now, so again, the best way to associate double diagonal, it's in the iron condor family. So what am I saying? If you like iron condors, for people who like iron condors, right? If you combine it with double diagonals, you can basically trade in any volatility environment, as long as the market is some kind of two-way or range bound. Does that make sense? Just like, if you look at two strategies that go together, let's say if you wanted to just trade, you can trade double diagonal and iron condor in any volatility environment, right? One in low vol, one in high. Calendars and butterflies go together too, like that. Trade calendars when the volatility is low, butterflies when it's high. So it gives you some choice, right? Right. So it's just having a couple extra tools in your golf bag. Now, so let's go over this. And again, I call this a craft for one reason, right? Right? Here's what I'm going to guarantee you. I'm going to guarantee you, if you never do a strategy like a double diagonal or an iron condor or a credit spread, you'll never get any good at it. That's mind-boggling. But I also guarantee you this, if you do 10 double diagonals or a strategy on paper, and then maybe you progress to doing it small, one contract, you know what's going to happen? You're going to get much better at it. So my biggest goal when I come here and do webinars at Interactive Brokers, how can I bamboozle the people watching to force them to actually practice the craft, right? You have to practice the craft. Now, you don't want to lose much money, so you go paper trading. Then when you get comfortable, small live trading, blah, 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 right? But that's how I learned it, being at the Chicago Board Options Exchange. That's how most traders learn it, right? Now, so here's the foundation. So if you look at this trade, and we're going to do one of these with Andrew after class, it looks a little imposing. There's 4 legs. But don't worry about it. You can trade these 4 legs it trades pretty easy as a spread, and it's pretty liquid a trade. So look at, here's what I want you to do, folks. First, focus on the green graph is the expiration graph. So this particular trade was 10 days from expiration. So the green graph is expiration. The purple graph, or the purple line, is the day I put it on, right? So that's typical what it looks like. And what most of you think, can you see, is this a bit of a shape of an iron condor, where the short strikes are further out of the money? Do you see that? In this example, SPX, or the vehicle I'm using here, is 6,000. That's the price it was. And I sold the out of the money call at 60.60, and I sold the out of the money put at 59.30. That's a short strangle. So would you agree that this looks a bit, it's kind of got the iron condor feel to it? Do you see that? Out of the money call, out of the money put, and then all I'm doing is buying my wings 5 points further out of the money. So on the upside, I'm selling the 60.60 call. And then, excuse me, on the upside, I'm selling the 60.60 call about 60 points up, and this is how I do it. And then I'm going to buy 3 days further out the NOV 25 calls, 60.65, 5 points further out of the money. On the downside, I'm selling the 59.30 puts, and I'm going to go 3 days further out than the NOV 22, buy the NOV 25, 59.25 puts, 5 points out of the money. So let's just, before I talk a little more how this thing works with the graph, how many think they at least get to have a clue the logistics? I'm taking the current SPX price. I'm going 60 points up, selling the 60.60 call. I'm going 70 points or so out of the money, right, on the downside. That's called a short strangle. So I'm doing it because I'm selling, this would be considered a high probability trade. I'm selling the call further away from the price on both sides, but then I'm buying some protection. The protection is I'm buying an out of the money call 5 points further out of the money, 60.65, and a put 5 points further out of the money, 59.30. So I'm paying $215 debit. That's the debit for it. But if I went in to do the trade, it actually has a margin or risk of $700. So your debit in this trade is not your risk. Your risk is $700. How many think they yes or no? Do you want me to go over the mechanics again, or do you got it? At least which strikes I'm selling and buying. So my shorts in this are 10 days from expiration. My longs are 13. Sold NOV 22, bought NOV 25. Yes or no? Dan, you stinking lost me. I'm going for the medicine cabinet. Or B, I think I have at least an idea of what you're doing here on the strikes. Give me 2 more yeses or nos. All right. All right. Now, here's how many think, right? How many think, well, so the graph, let me just say the graph again. The green graph, right? So what I want you to focus on the graph is, does everybody see you have the P&L along the left axis, right? There's a P&L that's on the vertical. Everybody can see that. The horizontal is different SPX prices. The green graph is at expiration in 10 days, and the purple graph is today, right? So you can see the green graph at expiration, you have between, Andrew, if you're there, do you have your famous pointer device?
Give me 1 second, Dan, to find that.
Yeah. So with this graph, Rick was asking this question. Go to the, so in this graph, we're putting it on at 6,000. There's 10 days to expiration. And go to the expiration break evens. So on the upside, that vertical red dot right there. So that's called, folks, the expiration break even, where the expiration graph, the green graph, crosses the 0 axis P&L at expiration. And on the downside, so on the upside, you can see that's maybe, I don't know, 61.10, 61.20, whatever that is. On the downside, that little line could be, it's a little bit below 5,900, maybe 5,880. So our goal is this. Let me say this in plain English. 10 days to expiration, my goal is to stay in this about 30% of the duration. How many days is that, folks? Whatever the duration is of the short, I'm looking to stay in 30%. So I'm looking to be in this about 3 days. So I make money between those two red dashes, right? Maybe 58.80 and 61.20, where Andrew had the red ball. So if you can show them that one more time. So between that, the red dash there and the red dash on the left, all the way to the left, keep going, right there. Yeah, the two red dashes in the middle are where kind of we're trading at. So you've got about 120 points on the downside, 120 points on the upside. So the question, folks, is, here's the question you would want to ask. Are we going to stay between those hash points? Are there probabilities that we're going to stay between those hash points? Maybe 61.20 on the upside, that upper arrow to the right, and all the way to the left, 58.80. Now, if you said to me, Dan, this is 10 days, if we held this to expiration, do you think the probabilities would be there? No. But I'm looking to be in this about 3 days, 30% of the duration. So the question is, does that make sense? And how many have heard of the term standard deviation or expected move? So I'm just giving you the edge here, saying, what's the edge, right? You want edge, right? How do you get edge on these trades? How many have heard of the word standard deviation or expected move? Yes or no? How many have heard of that word standard deviation or expected move? All right. So the question is this. Dan is saying he makes money between the red ball, 58.80 and 61.20. He's going to stay in the 3 days, 3-4 days. 10 days to expiration of your short options, November 22. Is that realistic? If you look above Andrew, can you red ball it where it says expected move 3 days? So the expected move when I looked at this trade, one standard deviation was 67 points. So what does that mean in English? It means from where I put the trade on, 6,000, there's a 68% probability we're going to be between 6,000 plus 67 on the upside. So take that red ball and go a little bit under 6,100 down there. Right around, maybe a little bit less than that. The other way, yeah, right around there. So we're saying, where is this thing going to be? They're saying there's a 68% chance this SPX will be up and down 67 points. So go to the downside, go down to maybe 59.30. Yeah, right around there. The bottom line is this, folks. There's at least a 68% probability we're going to be in the profit graph in 3 days, right? You say, Dan, why are you telling us this? Don't you want to know there's edge? Do you think just putting these things on and being good, and the market says, oh, you're a nice person, I'll help you. Does that make sense a little bit? How many would say that makes a little bit of sense? Even a quarter bit of sense. What did I just go over with you? Edge. Do you not want edge when you put a trade on? Where is your edge? Your edge in any of these trades, Iron Condor, Butterfly, Calendar, you don't, the edge, in my opinion, is not holding them anywhere near expiration. You get that? We're trying to make 7 to 10% in 30% of the duration. Everybody with me on that? So what would 7 what would 7 to 10% be? How many think our profit target would be on the debit or the margin? What do you guess? Will your profit be on the, well, I mean, it sounds like easy money, but again, this is a craft, right? I'm going to get to that in a second. Is it on your debit or your margin, right? Your yield on a trade, your profit on a trade is always based on your risk, right? In a calendar, your risk is your debit. In a iron condor, your risk is your, it's not your credit. Here, your risk is not your debit. Your risk is your margin. And how do you know that? We'll go with Andrew when we're going to simulate one of these on Interactive Brokers. Before you hit a trade, how many are aware? Does anybody, when you ever put a trade on and you start clicking it and it says your buying power will go down by X amount? That's your margin or your risk. Yeah. Peter says yield should be based on both debit and margin. That is not correct. If I'm wrong on that, Peter, help me. But your debit here is $215. That has nothing to do with your yield. Why? Because if I were to do this trade on a brokerage platform, the margin is not $215. Your margin is going to be $700, right? Your margin on an iron condor is not your credit. The amount of money you have to put up at your brokerage firm is not your credit with an iron condor, right? So some strategies it's the debit, some it's the credit. But the bottom line is my margin is $700. And if I'm trying to make 10%, that'd be 10% of 700 is $70. So if I pay $215 debit, I'd want to sell it at $215 plus 70 is $285. Let me say that again in Spanish, English, and Swahili. My margin is 700. If I'm looking to make 10%, I'm trying to make 70 bucks. There I take the debit, 215 plus 70 is 285. Does everybody get that? That's it. Now, somebody made a point. It sounds easy. There's nothing, it's not easy or hard. It's understanding how a strategy works, right? Does your broker allow you to earn yield on cash margin? Yeah, you can get, all brokerage firms are different, but usually if you have, extra cash sitting there, you can, that would be a question for your broker, but generally you can, right? And now that interest rates are higher, yeah, you can get something, or you can, that would be a question Andrew or could answer, or you could maybe put some of that money in some type of money market fund that you're not using, or they would have solutions for that. But let me give you the bottom line here, right? The key, whether it be to be successful double diagonal trader, or the key to a credit spread trader, or the key to a covered right trader, or, well, covered right's different. It's more of a long-term thing. The key to a calendar, or whatever these are more range-bound strategies. The key is to do them consistently, week after week, in my opinion. There's obviously you have to understand some things first. But the second thing is, you ready for this? This gets really deep, folks. If we're making roughly $60, $70 per contract every 700, if we're making 7 to 10%, let me ask you a question. And you don't have to be an option guru, whatever that is, to answer that. Most of these range-bound trades, when you stay in them about 30% of the duration, you know what you're going to notice over time? You're going to have about a 75% win rate. That's just, been doing this a long time. That's about it. But here's the key. When you lose, if you're making 10%, can you lose 30%? Do you think that would help or hurt things? If you're winning, if your average winner is 7 to 10%, can your average loser be 30%? Yes or no? Yes or no? Well, I don't think so. I would say no. So what I try to do is, let's just say my average winner is 10%. I keep my average loser, when I have a loser, to maybe 15. Does that make sense? If I have a high win rate and I can keep my losers under control, it's going to work pretty good. Does that make sense? But what is that? What character quality would you call it for someone who's going to say, you know what, when I'm down 15%, I'll get out? What character quality? Is that your knowledge of options, or what would you call that character quality? Someone who's saying, Dan, I'm pretty good at getting out when I'm supposed to. What character quality? What do you call it? What character quality? Is that your knowledge of options? No, it's discipline, right? It really is, right? You know, if I ask students, I've been mentoring, this is my 20th year. When I mentor with students, and that's all I do, and if there's a student who maybe had 2 trades he said, Dan, if it wasn't for these 2 or 3 trades, I would have had a wonderful year. I always say to them, always, could you have got out of those trades at around the max loss? I could have. Why didn't you? There's a million things there. I was outside playing with the tulips. Fibonacci, I thought the market would come back. I had a feeling in my belly button that the market was going to come back. My neighbor told me and guaranteed me the market would come back. Stupid stuff, right? I mean, and I'm not stupid, it's probably too strong a word, but the point is discipline, right? So here, right, let me go the other way. If I'm down 15%, what's 15% of 700 bucks? What's 15% of 700 bucks? What's 15% of 700 bucks? $105, let's round it to 100. So if I'm paying $215 debit, if that debit goes to 115, right, I'd get out. But again, the edge here is, then I would sell it for a 115 credit. But the edge here, now, I even talked about, and I won't get into a lot of adjusting and stuff like that today. Now, sometimes I do that, sometimes I don't. On these shorter term trades, 5 to 10 days from expiration, I don't like to do a lot of adjustments. You're just banking on that your profit area has more room than the expected move for the amount of time I'm going to be in the trade. So if this is a 10-day trade and I'm looking to be in it 3 days, 30%, 3 to 4 days, the expected move is we're not going outside these break evens in 3 to 4 days. Could it happen? Yeah. That's why I have my max loss. I mean, there's other things you could do. You could take one side off as it goes against you, but the thing is, I would say most of the time on this strategy, I don't adjust it. Now, how do you make money on this? Right? How do you think you make money? How do I get where I can buy it at $215 and sell it at $3? What are the mechanics here? Same as an iron condor. Your shorts, as we don't go too close to the shorts, the SPX price, your shorts are going to decay more than your longs will, right? Why? NOV 22, where our shorts are, is closer in than NOV 25. So as we go closer in, they will decay, right? And so, you know, a lot of times, and I'll show you an example of one I would put on today with Andrew, but, and that's it. Generally, I put these trades on. Andrew, you do me a favor. Andrew?
Yes.
Can you go for a second and take your red ball to the pointer to the Greeks on the left? I just want to go through those real quick. Just go through. So the first one says November 12th, Tuesday. So that's the day that I took this trade, this screenshot. The next one, that's SPX was 6,000 at the time, which you can see in the middle of that graph. The next one, VIX is 15. Generally, I like this trade when VIX is 12 to 15, 12 to 16, because it's and I'll get to that in a second why. But that's kind of the area that I like this. If it were to get 16, 17, 18, 19 VIX, here's a question to see if you guys are paying attention. If VIX were to get higher, like 17, 18, 19, 20, what strategy would I do? What relative of the double diagonal would I do if VIX were higher? Iron condor, right? So it's very easy, right? When VIX is 12, 13, 14, 15, I would do double diagonal. 17, 18, 19, 20, iron condor. 16, I call like in sports, if you were doing sports, pick them into either way, right? But so that gives me, A, from a volatility point of view, which one I pick. But let me tell you the most important. Let me ask you a question. What's the most important thing you want for a range bound trade? And don't tell anybody, but I just gave you the answer. What's the most important thing you're looking for in SPX for a range bound trade? Let me give you another hint. Range bound. Range bound. Does that make sense? It's not low vol or high, but I want range bound, right? It's not low volatility necessarily. It's now, when we say range bound, what does that mean, right? Now, I'm just giving you general things here because we're trying to give you everything on a strategy in a half hour, which is difficult. But range bound, what comes in my mind is two-way movement. In other words, Thursday in the SPX, we went down. Friday, we went down. What if today we were down 60? So that would be 3 days down every day. And I asked you, are we getting some two-way right now or whatever? You'd say, no, Dan, it's kind of trending right now. Then what would I do as a range bound trader? I might back off. Does that make sense? So I'm looking at like the last 7 to 10 days. Are we kind of I want some two-way. Does that make sense? Ideally, I want some two-way, and I don't want, that's the main thing. I mean, there's other things to get more specific. I don't like, when you're looking at a price chart, big candles, right? When you look at candles in a price chart, a big fat candle means there was a big range bound. I like, if I'm looking at the last 5 days, I want to see some two-way, but I like to see most of those 5 days that the distance between the high and the low, the top of the candle and the bottom, was maybe less than 50 points in SPX. When you start getting 70, 80, 90, it's too much movement. But a lot of this comes by just doing it, right? You're not going to have all the answers before you do it. The next thing, you see deltas there. Go to deltas, Andrew. And I'll get to your question. Someone had a question about stop loss. Deltas, that means 0.30. That's close to zero. That's like not even one delta. So that's just, I would call that option parlance a delta neutral. I'm starting out neutral. That doesn't mean the trade has a lot or a little risk. It's just saying I'm not starting out with a market direction. Gamma, you can go to the next one, Andrew. Gamma is minus 0.03. Anything minus 0.03, minus 0.02, minus 0.01, it's not good or bad. It just means that from a gamma point of view, it means gamma is just saying if the SPX goes up or down 1% or up or down 2%, do the deltas change a lot? And as a range bound trader, we get long deltas on the way down, short deltas on the way up. That's not good. So ideally, I would like a lower gamma minus 0.01, 0.02, even up minus 0.03. And that's not the whole story, but it just means that your deltas won't move that much for a given 1%, 2% move. Now, theta, go to theta, Andrew. Let me just ask everybody a question for sanity purposes. When you start talking the Greeks, and I'll get to the questions here in a second. When you talk of the Greeks, can you count on these Greeks, or are they theoretical? Can you count on these Greeks? Can you take it to the bank what these Greeks mean, or are they theoretical? They're theoretical, right? For example, that theta of 83, you know what that means? That means the day I put this on, it's saying in one day, this trade should make $83. It's saying because if you just put, if all you do in the pricing model is go one day forward from when I put this on November 12th to November 13th, it's saying I should make 83 bucks. That my shorts will decay more than my longs will lose, and I'll make 83 bucks. My margin on the trade is $700. $70 would be 10%. That theta is saying 11 or 12% in one day, right? If that were true, right, I wouldn't be on here. If that were 100% true, and I'm saying this jokingly, I would not be doing this interactive broker webinar. I would be on an island with Andrew. That sounds horrible. I would be, that Andrew would retire. That sounded horrible. I will be on an island, meaning if the expected move, right, if I'm only in this trade for one day, this would have an, this would be like, as they say, taking money from a candy, or from a child. This theta is a pretty good number, but it can be a little high. From trading these on a daily basis, I'm usually in these more than one day. This says that I can get 83 theta on margin of 700 in a day, right? That means I'd only be in one day. In reality, on a 10-day trade, I'm going to be in 3 or 4 days. Does that make sense? So that would be theoretical. And then the last thing, Vega, if you go to that with the red ball, Andrew, what that means in English and Spanish is that if you took the option volatility when you put this on of my long 60-65 call, my long 59-25 put, my short 60-60 call, my short 59-30 put, if you lowered the volatility, if the volatility of those 4 options, wherever they were, dropped 1 point with that positive Vega, I would lose $92. If the option volatility of those 4 options went up a point each, I'd make 92. And the thinking behind that, Vega's a little tougher to understand, is all of these are mostly extrinsic value. Volatility is a measurement of the extrinsic value of an option. So if the volatility of each of those goes up a point, my longs, I'm buying more extrinsic value than I'm selling. So if the volatility goes up a point for each of the 4 options, that Vega says I make $92. But again, it's making a theoretical assumption that all 4 options will go up 1 point. And that's not realistic. Now, it could happen, but it's not realistic. But the main thing, here's the bottom line. There's only 2 enemies on this trade, price and volatility. And price, the main edge on this trade is if I'm in a 10-day trade, if I have a 10-day trade, that's my expiration of my shorts, I want to be in about 30% of the duration, 3 days. If it's a 15-day trade, I'm going to be in it about 5 days. Sometimes I'll do a 4-day trade. I'm looking at being at 1 or 2 days. So that's where the edge is. But the key to any of these range-bound trades is, are you going to be a responsible American and get out when you have to, right? And that's discipline, right? And that's just a craft. And the other thing is, as you do these, right, I guarantee you, if Rick, William, and William did 10 of these, they'd get a little better at it, right? But if you don't do 10 of them, you won't get better at it. This isn't a head knowledge thing. Now, questions. Do you recommend having stop loss set up for options to avoid huge losses? I generally don't, but I mean, you can make the case, what if you're out of the country? But I would say if you're out of the country, what the heck you trading for, right? Don't trade. I'm around a lot of the day. You can put alerts in and that you can talk to Andrew about that. But if you have alerts in, I might put on this trade, I might put alerts near the break evens. And when it gets to a certain point, then you could open your computer, close the trade, but you can have an order in to get out for your 10% profit, right? And you can have that in all the time. It's a good till cancel order. I don't like stop orders necessarily because, especially if they turn into market orders, because that could be tougher. I mean, if you have no other alternative, I might, but I generally will put limit orders for profits. If it goes against me, I'll have kind of an alert. And I'm also watching the P&L. I'll have an alert if it goes against me, and then I'll take care of it. Question says, would you have internet on your island? Yes, we would have internet on the island. How is margin calculated? That's a good question. I'm not, in this particular trade, this mixed month trade, I'm not sure how they do it. I can tell you in a butterfly or a credit spread or a condor how it is. I don't know how it is, but I know I've done enough of these. It's going to be more than your debit. But again, on any trade, right, Andrew, on any trade you do, folks, as you're getting ready to do it on Interactive Brokers, it'll tell you, right? It'll tell you, hey, your buying power is going to be reduced by X amount of dollars when you do it, right? And you go from there. Andrew, is there another slide? I want to just kind of nail that, and then I'd like to put an example on. Are indexes better to use for stocks, for double calendars? I mean, I think, Andrew, am I allowed to give my opinion on like indexes or ETFs, or should I stay away from that?
You can give your opinion, Dan.
Yeah, here's my opinion. My opinion is, I think we only, for when I'm doing range bound trades, my opinion, SPX and SPY are basically what we use for 20 years. You say, why? Right? I don't want an Enron situation where I do a range bound strategy in the stock. That is a pretty extreme example. And the stock goes to zero or something, right? SPX is a well-diversified index of $500 stocks, relatively low volatility, tremendous liquidity. It trades a lot. I mean, it does charge a little bit extra commission, but I mean, charges but for most brokerage firms, you're going to be in the low $1.20 or whatever. I think there's a little bit extra because CBOE charges a licensing fee. I don't know if that's the right word to use, because I think they own the SPX thing, or they have a license with it. But I think SPX is the best for range bound trading. I mean, I still do it in stocks. If you have range bound stocks with a lot of liquidity, liquidity means lots of options trading. That's the key. So, your Apples, your Nvidias, your Teslas, stuff that trade a lot of options. I won't trade it if it doesn't trade a lot of options and give you good liquidity. So real quick here, I'll just go through this. If you have any questions, you can email me, Dan@Sheridan Risk Management. So what is a double diagonal? I explained that. Andrew, if you could do the red ball, I'll go through these real quick. What is a double diagonal? The first one, I'm selling Andrew, you there, my friend? Yeah, so what is a double diagonal? We're selling an out of the money call and put. That's a short strangle. Buying your wings 5 points further out of the money. I like to do these sometimes on a Monday for a Friday expiration, sell Friday, buy Monday. Other times I might do this like on a Wednesday for a week from the next Friday, expiration different. Double strategies just mean strategies that the foundation is a short strangle, selling an out of the money call and put. So double strategies, and this is our double series. The next one I'm going to do is iron condors. You have doubled calendars was the first one I did. Last month, double diagonals today, iron condors next time. You have another strategy called a double long diagonal, but these are strategies where the foundation is a short strangle. Edge in this strategy, if you lower that the red ball, edge in this strategy, remember, edge in this strategy is stay in the strategy about 30% of the duration. Don't bring it to expiration. That's where I think the edge is in two things. Stay in the trade 30% of duration, but the other thing is be disciplined, keep your losers not too far from your winners, like I mentioned. And I didn't get a chance to get into adjustments today, but that could be another day. Red ball, how does this differ from other double strategies? Comparing to double calendars and double long diagonals and those type of strategies. Double diagonals I like because you're buying your call and put out of the money. So you're buying less extrinsic value against it. These decay pretty quickly. Duration of strategy, generally I like to do these anywhere from 4 to 15 days from expiration. Strikes to sell and buy, I think, is a general guideline for these shorter term ones. Generally in SPX, sell your out of the money call and put 60 to 70 points up and down, and buy your longs 5 points further out of the money. Risk management plan, again, I'll have to do adjustments another time, but risk management plan, generally looking for about 10% profit on the margin, and I don't want to lose more than 15%. And we're looking for a win rate of about 75%. Time in the trade, as I said, not looking to be in the trade more than 30% of the duration. Does it mean that sometimes it might be, an extra day or so? Yes. And sometimes I might just get out because if I'm not getting out in 30% of the duration, what I found is the market ain't range bound, right? Anyways, that's, folks, is this everything in the world to know about double diagonal? No, but hopefully I'm giving you enough information that you could practice it. Now, I'm going to go over real quick. Hopefully we have a few minutes. Andrew, maybe as you're bringing it up, I can answer a few more questions if you're bringing up the brokerage platform. And Brandon says, why SPX over NDX? Not that NDX is bad, Brandon, but what I notice is SPX has better liquidity, trade more options. Nick says if you held it to the last day, which I wouldn't, then liquidated the spread, you can make a lot more money. Plus the price will stay in the range 66. As they say, Nick, you ever hear that expression? No way, Jose. Nick, you ever hear that expression? No way, Jose. If you held it to the last day, remember, the longer, let's sing the song together. The longer you're in a trade, the more the SPX can move. The longer you're in the trade, the farther SPX could move, right? So now, and you could try this yourselves. Yeah, it's not that, hey, I'd love to stay in this till expiration. And I'm not saying there aren't, again, I'm just trying to give you a bit of information today. There's times when I will stay in longer if we're in the middle of the graph and it's not moving to get a higher expected return. But generally, you don't want to stay until expiration. Gene says, how would you decide what strategy to use, iron condor or double diagonal or butterfly? Do you recommend using any indicator that would help with choosing the strategy? Absolutely, and I mentioned that. So let me give you a quick, Gene, this will take you at least 20 seconds to write down. You ready? Is a general guideline, since I have to give you this information quickly, between 12 VIX and 15 VIX, I'm looking at more calendars, double diagonals. At 16 VIX, you can pick, do a little of each. At 17, 18, 19, and 20 VIX, more butterflies, iron condors. How's that, Gene? That was quick. And that, you got that? Now, that's a general guideline. Again, I'm trying to give all this information quick. All right, Andrew, we ready?
I think so. Can I use the SPY to demonstrate this, Dan?
Sure. Yeah, that would be fine.
So
So
what
again,
I'm trying to do here is replicate what Dan's talked about for the last 50 minutes.
I can give you some strikes and stuff to go. I can
Yeah.
look at SPY and tell you what I would do. So folks, we're just looking, SPY would be like a Mr. T starter kit, right? SPY is 10 times less than SPX. So this would be a good vehicle to start on because it's going to be much cheaper, but we'll give you the same. So I'm going to apply the same. What I'm going to do is, folks, for this example today, we're going to do a double diagonal in SPY, and we're going to sell Friday of this week. I'll just do a shorter term one for this example. We're going to sell Friday, which would be November 22nd, and we're going to buy November 25, right? And this would be a double diagonal. So the strikes we're going to do, if I said we're going up.
Dan, hang on one second, Dan. I just want to cue this up for them so they know how to do this in the platform, right? So I've entered SPY into the order entry panel and drop down here. Two ways to get where we're trying to get ultimately. They'll both achieve the same thing. You can select the option chain or the strategy builder, and you will see if we go to the option chain, and I'll just move that screen over. If you're just seeing I'm just going to. What we're going to do is we're going to turn on the strategy builder at the bottom. So had I selected strategy builder, that would be turned on. It's turning it on, turning it off. Or you just select the option chain to get there. Or you could select the strategy builder. Right, now to get to the dates Dan's talking about, we want to be able to see the 22nd. November 22nd, so
you sell the November 22nd.
Right, and we're going to use the 25th as well. So we'll start on the 22nd. Dan, take it from there. Because all I'm going to do is I'm going to click on the different bids and asks to populate the strategy builder. Take it away.
Yeah. All right, so here's what we're going to do, folks. I'm just looking at SPY. Okay, so, all right. So I'll tell you what, we're going to sell November 22 and we're going to buy November 26. So this is SPY. SPY is 10 times less than SPX, same family. So I'm going to sell, and I can give you the calls I'm going to do. I'm going to sell, so I'm going to go 70 points up in SPX, which is 7 points in SPY. So I'm going to sell the November 22nd 595 call, right? Going up 60 or 70 points in SPX is 6 or 7 points in SPY. Going down 60, 70 points is 6, 7 points in SPY. So I'm going to sell the 595 calls. You with me?
I'm going to scroll up and select find the 595 line and then click on the bid price.
Yeah, so I'm going 7 points up on the SPY is at 588 right now. We're going to go up to 595, sell 7 points up.
Yep.
And then we're going to go on the downside. We're going to sell the NOV 22 581 puts 7 points down.
That's so you see in the strategy builder there. We're selling both?
We're selling both. We're going to do a few longs, but those are our short components.
Yep. The 595 call and the 581 put. Are we good so far, Dan?
Perfect. And then we're going to go to November. I'm going to just go a little bit different. I'm going to go to, in SPY, I'll go 4 days between the long and the short. So I'm going to buy November 26. And folks, I have a homework assignment for you, so pay attention to this. And do a screenshot of this, folks. Oh, this will be recorded. This will be perfect. So I'm going to give you a homework assignment based on this. All right, go ahead, Andrew. So I'm going to buy the 597 calls November 26. 597 calls. November 26, 597. Oh, you got it. And then I'm going to buy the 579 puts, Nov 26. So my longs are 2 points from my shorts. My longs are 2 points from my short in SPY. A little different setup in SPX just because it's such a cheaper vehicle. But take this setup, right? All right. And then you could hit a profile. Let me just look at yours, Andrew, and see if I got the right strikes. 595, 581 on the shorts. The longs, 597, 579 longs. Take it away.
There we go.
Yeah, so that's the graph, folks. Can you make it, can you zoom, can you make it like you have on your horizontal axis? Oh yeah, that's good. Yeah, that makes it, but yeah, he just zoomed it a little bit. Yeah, that's a great graph. And so folks, that's a double diagonal. So you can see Andrew, if he's got the red ball, those you got the same thing, right? It's the same. You got the break-even points are where the solid white line crosses 0, right, on each side, right? They're solid. And that white dotted line, that's what you would call the graph today, right, Andrew?
Yeah.
Yeah. And so over time, folks, between now and when our shorts is, so I would call this double diagonal, folks, a 4-day. So here's your homework assignment, folks. You ready? So you've got this, take a screenshot of this, you got it taped. What I want you to do, folks, here's your homework assignment. And if you can do this, for those who do this at least 3 weeks, and just email me, Dan at Sheridan Risk Management. Dan, I did it. Somehow communicate to me how you did it. 3 of these. I'll give you a free 2 or 3 weeks in our community where we have everything, all our videos, everything. And I'll do that as a way of encouraging you and thanking you for doing it, right? But I'm not going to give it to everybody because I want you to, if you're not going to do this for 3 weeks, it doesn't matter giving you all the information, giving you access to our community, you won't watch it anyways, probably, right? So here's the homework assignment. Every Monday around this time, you're going to go into SPY. How many think they could do this? You're going to go into SPY on paper. You're going to sell the call. So next Monday, you'll sell the upcoming Friday. You'll sell an out of the money call, 7 points up, out of the money put, 7 points down. And then you'll buy your longs, right? 4 days further, right? So if you're selling on a Monday, you're selling that Friday, you're buying a Tuesday. So you see the mechanics of this, folks? You're buying your out of the money calls 2 points further out than your short calls. You're buying your out of the money puts 2 points further out than your shorts. So you do this for 3 weeks. How many think they could do that? How many think they have enough information to do this based on what I said? Now,
Dan, while you
Demetra says, I did the same exact thing on IB and it showed the margin impact $400 and yours is 18. Again, remember, Demetrius, let's all do this together. Is your margin the debit? Yes or no? Is your margin the debit? In other words, it says $18. But Andrew, if we could you like simulate if you were going to do this trade, what are they charging you purchasing power? Like if you pretended to go do this trade. I gotta believe it.
Let's put in a limit price. And so Demetrius, how many contracts have you got there? I'm just doing a single contract there. I'm going to pay 20 cents. And then I'm going to click submit order, and we should get an order ticket to come up.
What does it say?
See if we can get rid of that profile real quick. There we go. All right, so it's costing me $16 there in maintenance.
Now it should be, see, maintenance. Let's see what it says there. 20, that says 20. Now, that would be wonderful if Interactive is going to charge 20 on that, 20 bucks to do this trade. I think it's going to be a little bit more. Do you have anything like purchasing power where they tell, is that what, so initial margin?
Well, it's a debit spread then, isn't it? So if it's costing me $20.
Yeah, but it's not like a double diagonal. The margin of this trade, the margin of this trade should be a couple $100. It should be $18. I mean, if it's $18 there, that's wonderful, right? If we can trade this for 18 bucks, I think it's going to be a little more. But like if you were trying to do this trade, do you have like a purchasing power thing where it says your purchasing power? If we did this trade, right, and we put in if we put in a price that we couldn't get executed at, would it show like the purchasing power effect on this?
Somewhere else in the platform, I'm not quite sure where at this moment.
Okay. But either way, yeah. Either way, how many people would say, I get the logistics of what you're doing, and I understand what you're doing. So if you do this 3 times, and I'll tell you what, if you want, if you need help, if you email me, for those who would like to do this for 3 weeks, but maybe get a little more help from the tutor here, if you just email me, Dan at Sheridan Risk Management, and just say help me with the double diagonal or something, what I'll do is next Monday, something like that, I could email you out the strikes or something to help you. Now, I think I was pretty clear what you need to do in SPY, but if you need a little extra help on that, email me and I'll send you the trades the first week or 2 just to get you used to it. But again, my whole thought, folks, is that practice, right? Do something. If you've been to a class on fettuccine alfredo or chicken parmesan, what's the point if you're not going to go home? Practice it, learn it. This is a good strategy, one of my favorite strategies. Somebody says, I did the same exact thing on IB and it shows me margin impact of $400 US, while yours show 18. But check on that. I forget who said that, but anyways, now, if you're going to close the trade, Andrew, how would you have it on here? I mean, how I close the trade, I would just do the opposite. There's got to be, like if somebody wanted, where is it on your broker? Like if you did this trade and then you wanted to close it, closing.
Yeah, so if I made the trade, it would let's just do that real quickly. I'll pay 21 for it and see if I can.
Yeah.
Oh, cancel. 21. Submit. And once the trade's executed, see if I get order filled. There we go. We're filled. So that will now be on my portfolio page, and I should be able to eggs. I haven't encountered this before, but
yeah, somehow you would.
yeah, I'm not sure that you can close the thing as a combination.
Okay, you can't just highlight it and create opposite trade.
Well, if it was a call spread, I could do that, but because it's involving 4 legs. I'll have to check on that, and we'll talk about that next time.
Yeah, and we'll, you know what, and what we could do is I can have Andrew will look into that and we can talk about it. And then for those of you who would like to do this for 3-4 weeks and get used to this strategy, you can, you could just do it. You can send me you can email me, and then I could correspond with you on these things, help you so you could do it 4 weeks. But anyways, any other questions? If not, I appreciate it, everybody. Hope you continue working on the craft. Thank you, Andrew. And
try that again, Dan. Let's do another one for.
okay, yeah.
For, what I'd like to try and do, we'll start with the November the 25th. So tell me what I'm doing here. We're going to
Do the same thing or different stuff?
Let's just create a different combination here. So we'll start with the 595. So I'm going to sell that one.
Yeah, so 595 calls.
And we'll do the 585 puts. We're going to sell that, right?
Yeah.
Right. And then I'll go to the 27th of November.
Okay.
And the 597s, buy those.
Yeah.
And then the 83.
Then buy the fives. So if you sold the 595 and 581, I'd buy the 597 and the 579, something like that. Or you could do a different strike. I'm just buying the call and put a little more out of the money.
Okay, right. So just have I got that the right way around then?
Let me just look at yours real quick. So you're selling the 597 and 579.
No. I'm buying.
Oh, you're shorts. Yeah, 595 and 585, 595 and 580. That's fine. You're just different combinations, and you're buying 590. Yeah, that's fine. How you got it is fine.
So now let me click on this button here to add to a watch list, and it's going to appear on my favorites watch list. Click OK, and I'm going to come to my favorites watch list up here, and here, there's the combination 11 credit at 4.
Okay.
So that will populate, and I'm going to click buy. We'll do two this time, and I'll set that price to credit of 4 and click submit. I'm just wondering if I create this trade, whether, because I've got it as a single line item there, that's filled.
Oh, I get you.
And I'll it's not showing it up. It's just aggregating all the options together. It's not. It defines it as a safe spread here on the favorites line.
So it lets you do it as one spread, right?
I can now sell that, right?
Yeah.
There we go.
One spread. Okay.
At a limit price of a credit of 10.
Yeah, let's check. Something.
There we go. And then click submit, override and cancel. And then that'll just sit there. I should probably put that in as good till cancel.
Yeah, so you can do that. You can do that.
Not from the portfolio page, not from the actual position, but because I've saved it to a watch list, so I can monitor the transaction throughout the week. Yeah, and all I have to do to exit it is just do the opposite. I click buy to begin with, and then on the closing portion of it, from the watch list, click on sell, and then close out from there, remembering to get the right quantity in there, and then define my price.
I got you. All right. No, that's neat. Yeah, I like the graph, since that's a nice. What's that called? The
strategy builder.
Strategy builder. Okay.
Yep.
Neat.
Yeah. So for any underlying into there, I'll pick I don't know, NVIDIA, and select the strategy builder.
Yeah.
And then you select your month across the top. If you don't see the nearby option that you want, use the more drop-down box. Click on the weeklies at the bottom, and that's going to now give us everything we want to see. So I probably want to do something like the 22nd, 29th.
Yeah.
And then just build it out as we did before, and
neat.
then save to a watch list, and then you can monitor that throughout the week. And as I said, put
nice.
Yeah.
So putting it on the watch list is the key. Then you could.
Yes. Okay.
All right. Well, thank you, Andrew. Thanks, everybody. Again, if you'd like to participate in practicing this for 4 weeks, just send me an email, Dan@Sheridan Risk Management. Or if you just want to do it, and then when you're done, If you're fine with the instructions, just do it and then send it to me. But folks, continue to work on the craft. We'll see you next time. We'll do iron condors. Have a wonderful weekend. And Andrew, as usual, thank you very much.
Thanks, Dan. And I've put Dan's email address up there, dan@sheridanriskmanagement.com, to get in touch with Dan. And if you need to get hold of me, if you want any more information on that strategy builder, I'll probably be able to dig out the video from Traders Academy explaining how that works. Contact me at webinars@interactivebrokers.com. Thank you very much, Dan.
Thanks, everybody. Appreciate it. Thanks. All right.
We'll see you in December.
Thank you.
All right. Bye for now.